Live from London, this is Bloomberg Daybreak Europe. I'm Lizzie Burden with your top stories. It's Friday the 13th and the AI scare trade frightens another sector, with logistics the latest to sell off. Stocks in Asia follow Wall Street lower. US Treasuries hold gains ahead of today's inflation report. Meanwhile, European allies pledged $35 billion in new aid for Ukraine as world leaders gather at the Munich Security Conference. We're there with top interviews throughout the morning. Plus, investors say not worth it. L'Oreal's ADRs slump after the beauty company's sales numbers disappoint. Well, a very good morning. Happy Friday. It is Friday the 13th and the mood is characteristically dire in these markets. We saw that tech sell-off yesterday stateside, the mood carrying on into the Asia session. But if there is optimism, we find it in Europe. Now unchanged when it comes to Euro Stoxx 50 futures. These are the only futures that really have been showing signs of optimism, but not right now. Gold is being snapped up ahead of that US CPI print later on. But Brent on for the first back-to-back decline of the year because of this broader risk-off mood, also because of the oversupply concerns and also because of the prospect of protracted US-Iran talks. Let's turn over to the risk events for the day. I mentioned the CPI print coming out of the US at 1:30 p.m. London time. The expectation at the core level is for a read of 2.5%. Meanwhile, in geopolitics, we're watching the Munich Security Conference. Oliver Crook, our chief Europe correspondent, is live on the ground for us. And earnings don't stop today. We get more from NatWest here in the UK later on, set to benefit from the growth of loan and deposits. But also, this is off the back of their Evelyn Partners deal, so we'll keep an eye on those earnings as we head into the European cash trade. Plenty on the agenda for today. Let's set you up for the day ahead. Wall Street suffered a fourth successive day of declines, with logistics the latest sector to fall victim to fears of AI disruption. Let's go now to Mark Cranfield, Bloomberg Markets Live cross-asset strategist for more. Mark, looks like the AI scare trade continues.
It's a remarkable turnaround if you think what's happened in just the last few weeks. At one point, everything AI was good. Everybody loved anything that was touching AI, and it was very good for the markets. And gradually, we moved into a situation where anything with AI software seemed to be at risk, and people were putting that out of favor and just sticking to the AI hardware makers, the big guys like Taiwan Semiconductor, Samsung, these kind of people. And now it seems to be sector by sector that AI tools seem to be dismantling trust in anything. So the latest one is logistics. This week we've also had wealth management, and we've had other sectors as well getting decimated because people think the costs can come down dramatically because these AI tools can do the job much better and cheaper and probably dismantle some of the workforce as well. So it's a tremendous change in investor sentiment, and it's really separating the winners and losers across markets. But in the past couple of days, it's simply turned into people just wanting to get rid of risk and to move to the sidelines. And of course, the flip side of that is that we've seen a strong bid has come back for the Treasury market in a way that we hadn't seen for some time.
Yeah, interesting that that's coming from tech. And yet we also have more macro data to bring today. That's the US CPI print. How could markets react to that, Mark?
Well, certainly the Treasury market will be at the forefront. It's been a very good week for Treasuries off the back of some soft beta and a very, very strong 30-year Treasury auction, one of the best for several years. So there's big demand for long-dated securities in the United States, even with the US dollar being slightly on the weak side. So let's say we did get an unusually high print for CPI, certainly Treasury market would be likely to take a jolt. But on the flip side, if we get in a really soft CPI number, which gets people thinking that the Federal Reserve could cut interest rates by 3 times rather than 2 times this year, then there's even more extension for the Treasury trade we've seen this week, and probably negative for the equity market. We probably reached a tipping point where bad news is just bad news for equities. People have known for some time that there's a possibility of the Federal Reserve lowering rates again, and it hasn't made much difference to equities this week. So if we get a CPI number which suggests that interest rates are still too high, that probably won't be taken very well by equities, but bonds will love it. and the dollar won't. It'll be another pretty bad day for the US dollar if it turns out that way.
Mark, thank you. Mark Cranfield there, Bloomberg Markets Live cross-asset strategist. Well, let's see how Asian markets are dealing with all this. We can go to Winnie Xu in Hong Kong. Winnie, it looks like that tech pessimism from the US has rippled into Asia markets where you are.
Yeah, morning, Lizzie. Exactly. We are seeing Asian markets pulling back a bit after having hit record highs every single day in the past 4 sessions. So yes, despite that near-term pullback, we are headed for our best week since September 2024, just because our region is actually a bit more insulated from this AI disruption that we're seeing in the U.S. because of our exposure to some of these upstream tech names in South Korea and Taiwan. And hence, you're seeing Samsung Electronics here actually up 0.7% after having its best foreign buying yesterday, hitting the highest yesterday. And also just flip the board and take a look at what's going on in the Chinese market, because actually both onshore and offshore stocks under some pressure today ahead of the Lunar New Year, and also some ongoing price competition going on among the Chinese internet companies just to try to secure customers during the holiday. In terms of the Chinese yuan, actually still around that 690 level, which is around its highest, strongest since 2023. Now, worth noting that we are actually going to be entering a week, a long holiday for Chinese New Year for the mainland Chinese stocks. So off for the entire next week, and for Hong Kong, just 3 of those days. Now, flip the board and take a look at what's going on in the Japanese market, because also seeing a bit of an unwind when it comes to the Takaichi trade, and hence we're seeing both benchmarks under a bit of pressure, but worth noting that they are actually both in the overbought territory already. When it comes to the Japanese yen, weakening just a bit, but it is also headed for its strongest week since 2024, and that's coming as concerns continue to ease around fiscal policy. Hence, it's also pushing the 10-year yield here further down. Back to you, Lizzie.
Winnie, thank you. Let's keep an eye on that yen off the back of the CPI print. The dollar only a touch higher in anticipation. Winnie Xu in Hong Kong, we thank you. Now let's get to the geopolitics. The UK Defence Secretary John Healey says that allies have pledged as much as $35 billion in new military aid to Ukraine to strengthen its air defences. It comes after a series of massive Russian airstrikes on energy infrastructure as well as civilian targets. Meanwhile, the US Secretary of State Marco Rubio says he expects to meet with the Ukrainian President Volodymyr Zelensky at the Munich Security Conference.
I think so. I think he's going to be there, and there's a chance to see him. I believe it's on my schedule. I'm not 100% certain, but I'm sure we will. It's terrible. It's a war. That's why we want the war to end. People are suffering. It's the coldest time of year. It's unimaginable, the suffering. That's the problem with wars. That's why wars are bad, and that's why we've worked so hard for over a year now to try to bring this one to an end.
Let's go to our Chief Europe correspondent, Oliver Crook, who's on the ground for us at the Munich Security Conference. Ollie, what more do we know about the Allies' commitment to Ukraine?
Yeah, well, we know it's providing the Ukrainians with what they need most desperately at the moment. This is what they've been saying really for months and really for years. It's that crucial air defense systems to knock some of these munitions from the Russians that they've been sending over in much higher volume over the last few months out of the skies. And we should say that obviously the Russians have been targeting energy infrastructure at a much higher rate. We should say again and again, it bears repeating that, you have hundreds of thousands of people periodically across Ukraine without electricity, without heat, in a moment when you have temperatures that reach minus 20, minus 23 degrees Celsius. So again, it's a very desperate situation. It really shows a sort of shifting tactic for the Russians, really trying to prioritize destroying that energy infrastructure all over Ukraine. So what we understand is that $35 billion, that is as potentially new money that is being pledged, led by the Germans, the UK, and a number of other Europeans. And what that will also include, this has not yet been fully okayed by the capitals that have committed it, but are some of these Patriot systems, 35 in total. The Germans say they will contribute 5 if you can get an additional 30. And again, this is very key, Lizzie, because for many of these things, these cruise missiles, the really fast-moving munitions that the Russians send over, nothing else can really take it out of the sky like the American-built Patriot systems. They're absolutely crucial as far as the Ukrainians are concerned. And of course, over the last 12 months, and a sort of administration in some way whose foreign policy was started right here 12 months ago by J.D. Vance, this is a Trump administration that is still, yes, selling some of these weapons to the Ukrainians, but donating them no longer. And that has, of course, been the major topic geopolitically here over the last year for the Europeans grappling with that.
Well, yeah, you remind us of the Van's comments last year. Of course, at Davos, the message was very much that we've got a new world order. So we're going to see European leaders surely trying to shore up the transatlantic order where you are in Munich. What else is on the agenda, Ollie?
So I think, Lizzie, there's two sides of this. There's on the one hand trying to salvage the transatlantic relationship because there is no alternative to a certain degree for the American security umbrella and all of that sort of thing. But I do think that something meaningful changed over that week in Davos that really severed the trust, I think, fundamentally, potentially irreparably during this administration between the Europeans and the United States. So there is the side of trying to build on that, trying to find areas of common ground. Potentially China could be one of those. We've been talking about potential aligned policy between the Europeans and the United States on raw materials. But there's another conversation here happening, Lizzie, and that is the fact that the United States may never be the same in the eyes of Europeans. So there's going to be, in my view, probably a lot of uncomfortable and a lot of quiet conversations in these corridors about what that actually means. Is, for example, the American commitment to NATO fully fledged? Again, this is a conversation we've been having for the last year. That turned into sort of a possible reality over the last couple of weeks. But another conversation, Lizzie, and this is something that I'll be talking to a number of people, including the German defense minister, is how secure is Europe under the American nuclear umbrella? This is a conversation that is apparently happening much more openly between European powers that would really only leave the French nuclear deterrent, because, as you know, the UK one is still fundamentally dependent on American technology. The Germans want to build the most powerful military within Europe. Can they have the most powerful military in Europe without a sovereign nuclear deterrent, for example? Those would be some of the conversations we're having here in Munich.
Ollie, appreciate the coverage. That's our Chief Europe correspondent, Oliver Crook. And as he says, we're going to have full coverage from the conference, speaking to many big names. Just a few from this morning include Kongsberg President Eric Lai, the European Commissioner for Defence and Space, Andrius Kubilius, Amundi's Head of Geopolitics, Anna Rosenberg, the PIMCO Vice Chair, John Sudzinski, and the Aspen Security Forum's Anya Manuel. So plenty to look forward to throughout the day. But still ahead on Daybreak Europe, we're going to dive deeper into how the AI-driven debt binge is threatening to disrupt passive credit funds. That conversation with Invesco's Alexandra Ivanova coming up at 6:30 a.m. First off, for the first time since the end of the Cold War, European capitalists are discussing how to develop their own nuclear deterrent. We'll tell you why next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe, 6:15 a.m. here in London. Well, as we discussed the Munich Security Conference, concerns over the reliability of US military alliance have prompted European leaders to begin unprecedented discussions about developing an independent, continent-wide nuclear deterrent. While France and the UK currently possess limited arsenals, the transition away from the American nuclear umbrella faces massive hurdles. Bloomberg's EU defence and foreign policy reporter Andrea Palaciano joins me now, also in Munich. Good morning, Andrea. Just remind us what triggered this concern about the reliability of the US military alliance.
I think there was really a specific moment that triggered this, and it's in March of last year, where for a few weeks the Americans turned off their intelligence sharing with Ukraine and to a certain extent stopped military deliveries. And the ripple effect of this moment is being felt until today, because that is the real moment when Europeans realized that it could happen to them. And the intelligence sharing, the weapons, and ultimately what underlies the whole security architecture, the nuclear umbrella, which is the one thing that the Europeans are most dependent on the US for. Obviously, there are some nuclear arsenals in Europe, as you've said, the UK and France. And so what is really happening right now at very low level, simmering under the surface, is the conversation about whether these arsenals could be applied to a wider Europe, how they could be shared, and the whole strategy behind that.
Yeah, in terms of Europe developing its own deterrent, how fast are these things moving and how far could they go? How realistic is this project?
Well, as you can imagine, they're moving really slow because we're talking about billions. There is no understating how expensive a nuclear program is. Obviously, there are also a lot of concerns about non-proliferation. So any country wanting to develop its own nuclear deterrent would be up against massive forces. Even just the upkeep of the French and the UK nuclear programs are extremely expensive. So we're talking about the beginning of a conversation, which in itself is a very massive shift. And we are expecting a bigger speech from French President Emmanuel Macron in the coming weeks, where he is expected to make a wider gesture to appeal to Europeans to get closer to the French nuclear umbrella and see what can be done.
Andrea, I appreciate the reporting. That's Bloomberg's Andrea Palaciano. Well, staying in Europe, but turning to tech now, quantum computing. Some see it as the next frontier in high-performance computing, built on a fundamentally different architecture that can, in theory, crunch data far faster than today's most powerful machines, with massive implications. Backers say the technology could transform entire industries, from drug discovery and cybersecurity to global finance and, as we've been discussing, national defence. Jan Geert, CEO and co-founder of IQM Quantum Computers, says it's vital that Europe plays a leading role.
There are actually more quantum computers deployed in European data centers than in US data centers. We have sold more quantum computers into data centers than any other company out there. So there is a way to lead also from Europe. We just have to find it. So in the US, people have been betting a lot on the cloud business model, which is fine. And we are also driving the cloud adoption. But on the other side, there is also a way then to lead on the infrastructure part and going into data centers.
But it begs the question, can the technology live up to the hype? And can it supercharge the AI boom? Well, Bloomberg Tech Europe takes a deep dive into those topics later on this morning. That's at 8:30 a.m. London time. But coming up right here on Daybreak Europe, Goldman Sachs' top lawyer resigns over her links to Jeffrey Epstein. We'll get you all the details next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Now, the president of the World Bank Group has told us that AI in emerging markets is far different from opportunities in the developed world. Speaking on Leaders with Francine Lacqua, AJ Banga shared his thoughts about how they stand apart.
Every day someone says multilateralism is dead.
Yes.
Do you agree with that?
No. Because during the last year or two, when things were really tough, IDA 21 happened. We got to raise money every 3 years for that part of the bank that goes to 78 poorest countries, because we give away 1/3 of the money every year without repayment. So it kind of runs out, even though we are profitable, and the rest of the bank runs on its own. But this one requires recapitalization. During this entire period, we recapitalized IDA 21, that is the campaign, at a record level, higher than ever earlier. And that was during the time period that the Japanese government changed, the German government changed, the French government changed a couple of times, the British government changed, the American government changed, the Canadian government changed, the Korean government declared martial law on the day of our event in Seoul. So even with political turmoil, there is a role for multilateralism. The question is, what kind of multilateralism, aimed for what? And that, I think, is the issue.
And so how has it changed? This is what public money that gets married also with private money.
Yes, absolutely. So that's a really important point, that you will find that fiscal constraints exist everywhere in the world. The developed world has its own issues.
Yep.
And therefore, relying on handouts is not going to work. I really believe in any case that handouts have a low outcome probability, and that you have to find a way to incent people to use the money they're getting, to use it for better. It's not that you don't need some handouts, but you do need, that's grants, but you do need as well the incentive to use that money to make things happen. And I think the private sector and private capital mobilization, combined with the money you can get from the public sector, combined with philanthropy, that's a good combination to work with.
And you can watch the full interview with World Bank Group President AJ Banga on Leaders with Francine Lacqua, which premieres today at 5:30 p.m. in the UK. It's also going to be on the Bloomberg Original stream, the Bloomberg website, and of course on the terminal. Now, to some of the top stories we're following this morning. Goldman Sachs' top lawyer, Kathy Ruemmler, is leaving after documents released by the Department of Justice showed her links to the sex offender Jeffrey Epstein. The CEO, David Solomon, has said she'll be missed. Ruemmler moved to Goldman in 2020 and later became its legal chief. The bank says she had disclosed her dealings with Epstein when she was hired. Next, President Trump says negotiations with Iran could go on for a month as he seeks a diplomatic agreement that would roll back Tehran's nuclear ambitions. The US president also says it'll be very traumatic for Iran if there's no agreement. Trump's comments came a day after he hosted the Israeli Prime Minister at the White House.
It's ultimately up to me. If the deal isn't a very fair deal and a very good deal with Iran, then it's going to be, I think, a very difficult time for them. I'll talk to them as long as I like, and we'll see if we can get a deal with them. And if we can't, we'll have to go to phase two. Phase two will be very tough for them. I'm not looking for that.
Elsewhere in geopolitics, Bloomberg has learned that Venezuela plans to grant more oil production land to Chevron and Repsol. Sources say officials in Caracas are preparing to award the exploration and production blocks as soon as this week. The US Energy Secretary has been touring a project operated by Chevron in Venezuela's Orinoco oil belt.
Now, with, again, a very groundbreaking approach, we have so much influence over Venezuela that we're able to nudge things in the right direction, maybe more than nudge. But I think we're aligned. What's in the best interest of interim President Rodriguez is to enhance the lives of Venezuelans. As society opens up and moves towards democracy, you got to be popular with the people.
The US and Taiwan, meanwhile, have finalised a trade deal to cut tariffs and boost market access for American products in Asia. Taiwan has also pledged to buy more than $44 billion worth of American LNG and crude. In return, tariffs will be cut from 20% to 15%, with exemptions for generic pharmaceuticals, chips and smartphones. Well, those are some of our top geopolitical stories this morning. Let's check in on these markets. Of course, it's been a really busy week when it comes to US economic data. We had payrolls earlier. Today, we're expecting CPI. We started the week with retail sales. And this is how markets are looking heading into that inflation print. The expectation is that we're going to get core CPI at 2.5%. Economists flagging that usually January prints higher, but this could be a bit more of a lukewarm number. And so what you're seeing is traders snapping up gold heading into this number. The Bloomberg Dollar Spot Index pretty range bound and Treasury yields higher across the curve heading into this number. Now, let's also take a look at the futures picture this morning. As I say, it's Friday the 13th and the mood has been pretty dour in these markets. We saw a sell-off in tech yesterday. Nasdaq down 2% yesterday. If we can show what's happening in the futures picture, we've seen Asian stocks selling off, so turning the fortunes that we'd seen earlier on in the week. US futures have been lower. Where are they right now? Still in the red this morning. We had seen a bit of optimism here in Europe as well, and sometimes this morning in the US, but really we're treading water as we head into the last session of the week. But coming up, we'll still be talking about tech, this time how the AI-driven debt binge is threatening to disrupt passive credit funds. We'll dive into that conversation with Invesco's Alexandra Ivanova next. Stay with us. This is Bloomberg. Live from London, this is Bloomberg Daybreak Europe. I'm Lizzie Burden with your top stories. It's Friday the 13th and the AI scare trade continues and frightens another sector, with logistics the latest to sell off. Stocks in Asia follow Wall Street lower. US Treasuries hold gains ahead of today's inflation report. Meanwhile, European allies pledged $35 billion in new aid for Ukraine as world leaders gather at the Munich Security Conference. We're there with top interviews throughout the morning. Plus, investors say not worth it. L'Oreal's ADRs slump after the beauty company's sale numbers disappoint. Well, a very good morning. Welcome to Friday the 13th, and the futures picture is appropriately dour this morning. We've already seen that tech sell-off stateside yesterday. That mood continuing in the Asian session. It's reflected in the US futures picture this morning, as it is here in Europe. But traders snapping up gold as we head towards the US CPI print. That comes at 1:30 p.m. London time. And meanwhile, oil set for its first back-to-back weekly drop of 2026 on this broader risk-off mood, but also because of those oversupply concerns and the prospect of protracted US-Iran nuclear talks. Let's take a look at the front pages this morning. We'll kick off with the Financial Times, shall we? They've got this story about Goldman Sachs' top lawyer. That, of course, is Cathy Ruemmler. She's set to resign this summer after documents released by the US Justice Department revealed the extent of her ties to the late paedophile financier Jeffrey Epstein. Now, you'll remember that Ruemmler was well known for her time as White House counsel in Barack Obama's administration before she was hired by Goldman in 2020. So that story on the front page of the Financial Times. Flipping over to France, and we have Les Echos this morning. They have the headline that competitiveness, Europeans commit to a strengthened single market. Well, French and German leaders are doing their best to project unity. They were at this leaders' one-day retreat in Belgium. But this paper saying behind the polite smiles, the cracks in the axis were obvious to all. Let's also turn over to the Wall Street Journal. They've got a story about the Trump administration covertly sending thousands of Starlink terminals to Iran. This is after, of course, the regime's crackdown on demonstrations last month. But the administration seemingly trying to keep dissidents online after Tehran stifled internet access. So this according to US officials who've been speaking to the Journal. But you can get a roundup of all these stories and everything you need to know to get your day going in today's edition of Daybreak, which, as ever, terminal subscribers can find by going to DAYB Go. Now, let's get back to tech. It's already becoming a larger slice of bond sales, with analysts expecting even more hyperscaler supply as capex surges. Joining me now for more on this and the wider bond market is Alexandra Ivanova, fund manager for the IFI Europe team over at Invesco. Lovely to have you this Friday morning. Let's start with tech then, because we are constantly talking about fears about AI capex. We've had this 100-year note coming from Alphabet this week. As tech makes up more of the high-grade issuance coming out of the US, at what point do you get worried about concentration risk?
Well, it is a good question, because this 100-year bond in UK sterling market has been one of the biggest in history.
Yeah.
But given the appetite and investors' readiness and waiting for this kind of issuance, the demand has been so strong, which surprised even ourselves. And we've seen books covered almost 10 times on that 100-year bond. And on the break, the bond has traded okay. I did not expect that it's going to rally that quickly. But at the same time, I would say that the amount of supply that's coming into the investment grade market does pose a question in terms of what kind of spreads over gilts, over treasuries we need to get to be paid properly for these kind of bonds.
Yeah, we've got a great story on the terminal this morning about the rapidly growing pool of passive buyers and the potential disruption from that. Are you concerned about that?
Well, the passives will be looking at the index. So if there is an index inclusion, there is going to be much broader support for these kind of issuers. And given the level of yields, and of course, we'll look at the long end, for example, this 100-year bond is over 6% in sterling. Historically, we haven't seen these high yields. And for 100 years, if you say, nobody knows whether Google is going to be there in 100 years, but it is much more likely that we will get good types of returns, but it is very risky because you are exposed to a lot of underlying gilt volatility in that part of the curve.
It's like they always say, the church thinks in centuries, but now tech's thinking in centuries. Really significant moves. But I do wonder, are there other particular sectors where credit fundamentals are not holding up so well at the moment?
Well, There are sectors that are probably not necessarily related to AI. For example, chemicals have been quite in doldrums for the last couple of years. But what the credit market is starting to price is the AI losers, or the software, for example, is one of the areas that has been underperforming more recently. And if you look at the details of the companies that are actually suffering this kind of sell-off from investors, it's more about investors selling first and asking questions later, because in some of these companies, I would say, first of all, credit metrics do not necessarily look that bad, but you could question the business model, whether that's going to survive. Or it could be a company that is a conglomerate that has a lot of different parts of the business that you could argue some of the part of the businesses are actually going to benefit from AI, but it's very easy just to sell first, and also the technicals that have been so strong are starting to turn, in my view, because what we are seeing is that if for example, a company issued a lot of bonds in the recent months, all investors are already long. So then it becomes heavier and harder for them to outperform.
Okay. I also want to turn to sovereigns because, of course, we've had a massive week for US economic data. Interesting warning from JP Morgan strategists recommending selling 2-year Treasuries as a tactical trade because they think all this data makes it harder for the Fed to cut rates. Would you agree with that?
I actually would agree with that, because I do worry about the market pricing in perfection in terms of the expectations for the rate cuts. Obviously, we are going to have the new Fed chair, and it's a Trump appointee. But by the way, Powell was also appointed by Trump.
Of course.
So, and we are reacting to data on a day-to-day basis. Let's see what the CPI is going to bring today. And I think benign CPI print probably will be positive for risk markets. However, if we surprise to the upside, I do worry that investors will start questioning whether we are too benign and we are expecting too many cuts. And I've seen some strategists calling for 4 cuts, and I just don't see it unless we actually go into a recession.
Is there a January CPI print that could put a June cut back on the table?
Well, I think so, if the CPI surprises to the downside. But we all know that most of the downside surprises are coming from, for example, very structural housing part of the CPI data. And more cyclical month-to-month data might actually surprise to the upside. And if you just think about how resilient the economy is and the demand side of the AI expansion and cyclical upward trend in industrials and consumer still holding up, and don't forget, we still are waiting for these checks in the mail or rebates that are coming in this side of the 2026. I do think that there is a surprise element that maybe demand is going to be strong, that will be underlying inflation that underpins it is going to stay stickier.
But of course, we're in a midterms year. I do wonder what happens to the US economy after 2026. But I also want to talk about the UK, because your latest note on gilts had a bit of a I told you so air about it. After the budget, you were expecting a bit of a bumpy ride, right? Yeah. And we've had it this week. Is it any part of the curve safe as we head towards the May elections, as we keep an eye on Keir Starmer's stability in Downing Street?
Well, actually, so I think the front end looks okay, and I do think that the Bank of England has room to cut, and they have kind of soft signal that March potentially could be where we see the cuts coming through. And the long end, I still feel like it's going to be quite volatile, but yeah, for diversification purposes, maybe you still can invest in it, but you just have to be careful and active. So we've used these opportunities where the gilts have actually rallied into year end and they outperformed. So that was a good opportunity to rotate out of it. And once we sell off, I think, at some point good levels to get back in.
Okay. Alexandra, great to see you. Thanks for coming in on a Friday morning. That's Alexandra Ivanova, Fund Manager for the IFI Europe team over at Invesco. Well, coming up on Daybreak Europe, investors say not worth it. L'Oreal's US ADRs selling off after sales at the world's largest beauty group missed estimates as its luxury division underperformed. We'll bring you all the details next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe, 6:43 a.m. here in London. Now to our top corporate news this morning. Citigroup has boosted the 2025 pay of its CEO, Jane Fraser, to $42 million. The 22% pay rise follows a year which saw the stock surge more than any other Wall Street bank. The pay bump also puts Fraser's total package for the year just $1 million shy of that of Jamie Dimon of JP Morgan. Elsewhere, Anthropic has completed a $30 billion fundraise led by sovereign wealth fund GIC of Singapore and Counsel Management. The deal values the AI company at $380 billion, making it one of the world's most valuable private firms. Anthropic also confirmed plans to let employees sell shares at the same valuation. In other news, Applied Materials surging in late trading after delivering a surprisingly upbeat sales forecast, signalling that demand for artificial intelligence and memory semiconductors is fueling equipment purchases. The largest US suppliers of chip-making gear expect revenue of approximately $7.65 billion in the fiscal second quarter. Applied Materials is bouncing back from a slowdown spurred by export restrictions on China, the biggest market, of course, for chips. And Coinbase has reported a 20% plunge in fourth quarter revenue as falling token prices sapped trading activity. That contributed to a net loss of $667 million compared with a $1.3 billion profit a year ago. The stock has fallen almost 40% this year alone, tumbling on the latest bout of selling in Bitcoin. So those are some of our top corporate news this morning. Meanwhile, staying with earnings, L'Oreal shares seen opening lower. This is after the French beauty maker's sales failed to meet analysts' expectations in the final months of last year. And we could go now to Angelina Rascouet, who joins us now from Paris. Angelina, good morning. These results seem to feed into the China and luxury narrative. So just walk us through what your key takeaways were from these earnings.
Hi there, Lizzie. Well, looking at the results last night, especially the reaction in the US, the ADRs, they fell, and it sounds like it's going to be a lower open today, this morning in Europe too. When it comes to the luxury division, L'Oréal missed estimates. That's the division that includes brands like Aesop, like Yves Saint Laurent, which is, represented by Dua Lipa. And typically these are high-end fragrances where, that unit should perform really well in the last quarter of the year because it's the Christmas shopping season, and they disappointed. They cited ongoing challenges in the travel retail segment in Asia. So that's been an issue for some time already. We're going to have more details in about an hour at the Analysts and Media Conference with the CEO and the rest of the executives of all the divisions, the main divisions. On the flip side, on the positive side, the dermatological beauty unit performed really well by 11.5%. So that's the one that includes brands like La Roche-Posay, which is the growth driver, they said, and CeraVe, which is a brand that is launched new products and it's in turnaround and it's doing better. So that's overall the outlook. But again, as I said, we're going to have more details.
OK, well, as we await those details, what do we know about what their strategy is likely to focus on in 2026, Angelina?
So I guess investors will be, first of all, they will expect Nicolas Hieronymus, the CEO, to tell us what's his growth outlook for the overall market. L'Oréal tends to give that number. And then they often tend to say, we expect to do better than that growth numbers. So we're going to expect that. But L'Oréal, M&A, they've been a very acquisitive company. Last year, they did a huge deal with Kering. They basically bought Kering's beauty unit. It was an emerging unit within Kering, but they also bought the perfume Creed. And eventually, the plan is for them to also manage the Gucci license. Right now, it's still with Coty, so a competitor, but eventually it'll be liberated from that license, and L'Oréal will get it. They also bought a few years ago, they bought Aesop. And there's going to be also the question when it comes to Armani. Mr. Armani died in September. In his will, he said he named 3 preferred bidders for his an initial stake of 15%. So that was EssilorLuxottica, LVMH, and L'Oréal. And so L'Oréal has had a beauty license with Armani for many, many years, and they have, in total, I think it's a 50-year license. So I think the market expects it will try to secure it eventually. We don't know by how much, but it's a very important license for L'Oréal inside the luxury unit. So so that's what we expect from them.
Okay, Bloomberg's Angelina Rascoway out of Paris. We thank you as we look, as you say, for L'Oréal shares to be lower at the European Open. Well, as the world focuses on Milan and the Winter Olympics, it turns out that the city has been attracting attention for a number of years. If you're anything like me, you've had one eye on the markets this week, the other on the Olympics. But I travelled to Milan for Wall Street Week to find out what's really drawing the ultra-wealthy and the big concern facing the city.
In the upscale Porta Venezia neighbourhood of Milan, Rich Ross is right at home. The former Hollywood executive bought this apartment with his partner in 2021, relocating from Los Angeles.
Well, every friend of ours, there are 2 words, why Milan? Like, why Milan? And then when we're here, they say, why here?
Ross is one of a number of wealthy foreign individuals now calling Milan home. Data from Henley & Partners estimated Italy added 3,600 millionaires last year, the third most in the world, while the UK, France and Germany all recorded net losses. Most of those going to Italy ended up in Milan, with many attracted by the country's flat tax regime, initially €100,000, but since raised to $300,000.
What brings you back to Italy?
The food, obviously.
Luigi De Vecchi is one of Europe's top deal makers. Educated in Rome, he had stints around the world at Goldman and Citi and was hired by Evercore to return to Italy to lead its expansion through Europe.
I think there are many places that have tax havens, but I think there is no doubt that people have taken that into consideration, as so many people moved out of London, but also out of Paris. I have friends that have come from all over Europe and actually the US, because unfortunately this time people, for different reasons, decide to move. And Milan, Italy in general, has become a very attractive place.
Yet Milan's rise has opened up problems. Housing prices have surged up about 38% in the high-end sector between 2020 and 2025, according to real estate firm Knight Frank. And demonstrations broke out in the city ahead of the Olympics, with many fearing the Games will exacerbate cost of living concerns, even as the IOC says it'll repurpose the athlete village as student housing.
What could derail the momentum that we're seeing in Milan the fastest?
I don't think that I see a change of direction in terms of foreigners coming in. But what I think is changing, and this is dangerous, is the attitude of the Milanese that has always been an attitude that has been very welcoming. Milanese have something very special compared to other places in Italy. They're very reserved. They're very, the beauty of Milan is hidden. So most of the big palaces have gardens that you cannot see from the outside. And Milanese don't like to show off. So some of the wealthiest families in this town are not people that you would, they drive a Fiat 500, not a Ferrari. And so this influx of foreigners who are very wealthy,
flashy,
and sometimes flashy, could create some kind of backlash.
Prada, pizza, fashion, finance, what more could you want? Well, catch the full episode of Wall Street Week airing tonight at 11 p.m. London time. And you can also now watch Wall Street Week on our video hub. We've got live streaming news, all our interviews, all our Bloomberg TV shows, documentaries, reporter analysis and more, all in one place at bloomberg.com/videos. Plenty more coming up, though, right here on Daybreak Europe. So don't go anywhere. This is Bloomberg.
It's still slack in the economy, increased potential output that can be accommodated by looser monetary policy. And so the combination of these things leads me to think that monetary policy is tighter than it needs to be, and that we can afford to have lower interest rates.
Fed Governor Stephen Miron there, still determined that more rate cuts are needed. Let's see whether today's US CPI print changes his mind. It's the last instalment of data this week. We've had a raft of economic data already, but the expectation on the front of core CPI is that it's ticked down from 2.6% to 2.5% year on year, as you can see here. But flip the board over, and really the Treasury market's not just been impacted by the economic data this week, but also because of the tech sell-off. Nasdaq down 2% yesterday. You can see here the Nasdaq down days piling up so far this year. But flip the board over and I can show you the impact on the Treasury market, because it seems like perhaps President Trump's getting what he wants, reduced rate expectations. Treasuries rallying across the curve yesterday as a result of that tech sell-off. Let's see if it continues today, because we have seen a lot of negativity in the futures picture and Asian stocks already down in their session. Turning over to the risk events on the docket for today. As I say, we've got the CPI print coming out of the US at 1:30 p.m. London time. We're also keeping an eye on the geopolitics. The Munich Security Conference starting today. As ever, we have the future of NATO very much in focus, and the future of the war in Ukraine. So our Chief Europe correspondent Oliver Crook on the ground for us. And at the top of the hour, we'll bring you NatWest earnings, very much in focus, with loan deposit growth boosted here in the UK, so they're set to benefit from that. They've just had the Evelyn Partners deal, and we'll have an interview with the NatWest Group CEO, Paul Thwaite, in just a few minutes' time. That's on the opening trade. Anna and Guy and Tom will take you all the way to the cash open. This is Bloomberg.